Alrighty, let's get this going. Can y'all hear me? Just making sure. Okay, I'm Erin with Straight Line. It's 11 o'clock. I'm just going to dive right in because this is a fairly complex topic that is going to take a little while, and I don't want you all to fall asleep in an hour. So, Erin again. I'm Erin with Straight Line. We've been specializing in the PPP and all COVID-related business relief loans, grants, funds, whatever, tax credits since the start of COVID, which was exactly right about a year ago now. It's been a long year. But today I'm going to talk about the ERC and the PPP. The PPP we've talked about a lot. The ERC I did start bringing up last webinar, which was January 21st. It's a really, really excellent tax credit that was not discussed before because you could not have the ERC and the PPP together prior to the legislation changes on December 27th. But now that it is available, it's great, but there's also some stuff that you have to be aware of regarding the PPP, combining with the ERC and all that fun stuff. So let's get going. 1 second, all right. So just a little housekeeping per usual. All questions are to be asked in the Q&A section. Please don't, I think the chat is actually disabled. We will have the slides and additional content available after this, and as well as the actual webinar, and we will email it to you. At the end, we will have an open forum portion for you guys to ask questions. However, throughout the webinar, I will try to do my best to look at the Q&A. Amber and Jake are both on the webinar assisting me. And they're going to try to answer questions as we go, but sometimes it's nice to read them out loud in case other people have questions. If you do have questions at the end, we will unmute you when it's your turn. And then also please check your spam or junk filters and add our domain, the @straightline.com. It's a very weird business name, as most of you probably think, and it goes to junk a lot and spam a lot. So we send a lot of information out about all these topics. Okay. So as I always say, warning, this is an explanation, interpretation of the CARES Act and its updated version based on best efforts, reviewed the legislation. And most certainly it probably will be changed. One or more items as everything has been going. I mean, they just changed the law for the 2020 rules in December, and they don't even have final guidance out on a lot of this stuff yet. So again, we're just sort of doing our best guess here, or educated guess and research on these items. We will learn more when they issue new facts, FAQs, and again, webinar will be recorded. So just be aware this could and probably will change. So my agenda is going to be, I'm going to go over the ERC. So the ERC is the Employee Retention Credit. I'm just always going to say ERC and PPP. I'm not going to say the Employee Retention Credit. So ERC 2020, then the ERC 2021, how it interacts with the PPP, and then go over questions if there's any at the end. So just to recap, the ERC and the PPP, so the Employee Retention Credit is a tax credit available to businesses that pay wages despite being shut down or having a downturn in gross receipts. So that's revenue, income, money that you bring in. The CARES Act, which created the ERC, said a business that received PPP forgiveness was not eligible for the ERC at all. So effectively, if a business received a PPP loan, it could not claim the ERC. This was prior to the Certainty and Disaster Tax Relief Act of 2020 on December 27th. So this all changed, and it changed retroactively, which is why, again, nobody really spoke about it, because most people were not eligible for it, but now we are. So the ERC for 2020 is if a business could show a 50% revenue decrease for any quarter, well, for the second, third, and fourth quarter 2020 compared to the same quarter in 2019. It's for small employers, so that's defined as 100 or less employees. There's employers could qualify if you have 100 or more employees. I'm not really going to go into any of that because I don't think anybody even on here would qualify for that. So I'm really not going to waste anybody's time talking about 100 or more employees. But if you do have 100 or more, you do qualify, but there's restrictions. And this was the only test. So, I mean, there's certain industry restrictions such as, but we don't need to go into those because no one really falls into them. But for large employers, the employees had to pay to stay home and not be working. So that's over the 100 employees. The credit was up to 50% of the qualifying wages, up to $10,000 or a maximum of $5,000 per employee. And that's for the entire year of 2020. And then obviously the PPP borrowers were not allowed to take this credit, which has changed. The credit is claimed on quarterly payroll tax returns. It's the 941 and therefore reduce the required payroll tax deposits. But you also get an additional credit if you use up all of your tax deposits. And that's filed a 941X and it has to be filed for every quarter, which I'll go into a little bit. So qualifying for the 2020, there's two qualifications and you only have to hit one of them. So the first one is full or partial suspension of the business's operations during any calendar quarter because of governmental orders limiting commerce, travel, or group meetings due to COVID, or a significant decline in gross receipts defined as gross receipts for a calendar quarter in 2020 are less than 50% of what they were for the same calendar quarter in 2019. And once a business qualifies this way, they continue to qualify until the quarter in which the gross receipts return to more than 80% of what they were for that quarter in 2019. I know, super confusing, right? I'll go into it more, but basically what it's saying is that second quarter 2020, if your gross income, your sales, however you refer to it, your top line is at least 50% or more less than what you brought in that same quarter in 2019, then you qualify. And then the next quarters qualify depending on certain things, but that's where it gets really confusing. So I wanted to go into the partial shutdown because I know a lot of clients, even though they might not qualify for income, they could qualify for the partial shutdown orders. And it can be very confusing about the partial shutdown. So I'll go into this a little bit. So government orders that restrict hours or capacity count generally count as partial shutdowns and thus a business qualifies. So for an examples, restaurants with capacity restrictions or factories that operate fewer hours than normal because of government mandated COVID cleaning requirements. I will go into more examples of these. They're all over the place. Technically, it depends on if the shutdown order has more than a nominal impact on operations. So I love how the IRS does this. I think it's how everybody interprets nominal. I think it's going to be a very loose interpretation for some people, but another example, a retailer is allowed to be open with social distancing and capacity restrictions. And the IRS's fact pattern, in this example, the retailer has a large store and thus the restrictions only have a nominal impact on the business and thus the business does not qualify. However, the flip side, if you're a small business and a small retailer and you have limited, people that could be in your business, then I would say you do qualify. So I guess this example would be like a Walmart, which is why they were open the entire time. So limited operational hours. So if a business is forced to close at a certain time due to government mandated curfew, the inability to operate under normal hours would be considered a partial shutdown. So I looked up this example in New York, apparently Buffalo, New York, they're big football fans. And they would watch a football game from local restaurants. And games, as most football games do, they run, if there's a late game, they run over. But due to a 10 p.m. curfew enacted by New York State as part of the COVID containment policies, the restaurants had to close early and fans could not watch the entire football game at the restaurant. So even though restaurants were operating from noon until 10 p.m., the inability to operate under their normal hours would be considered a partial shutdown. Now, obviously, I'm assuming this restaurant also had other restrictions, such as the amount of people they could have and all that stuff. So that's still another shutdown, but this is just sort of a broad example about hours. So this could be the case, like the other example was factory. They had to clean, they have to stop doing things. And I think some other places are like this, where they have to stop and clean for a certain time period, which they cannot operate their business. So that would constitute a partial shutdown. So general rules surrounding the ERC states that essential businesses do not qualify under the partial shutdown test. They could qualify under the gross receipts test. However, because an essential business could be open, their argument is you are fully open. A significant exception is to this rule applies that the suppliers of the essential business are unable to make deliveries of critical goods or materials due to governmental shutdown, governmental order that requires the supplier to suspend its operations. So an example is, let's say California production is shut down due to state restrictions. So they produce widgets for something, and in Ohio that they send to Ohio, an Ohio manufacturer. Ohio is considered an essential business. Let's say Ohio makes masks, but they can't actually operate because they don't have the materials needed because California is restricted. The Ohio manufacturer is now considered a partial shutdown because of their supplier, and they could be eligible, and they are eligible for the ERC. So as you can see, a lot of this stuff is going to get a little hairy. I do recommend, if you're really questioning if your business qualifies for a shutdown or not, I did provide a link here. It's the IRS questions. They give a lot of examples. Another example, we do actually have a client that's a manufacturer, but they're also a professional. And one of the other, so what they did, a lot of their employees can work remotely from home. So that portion of their business, they're able to continue kind of like normal, quote unquote, normal operations, but their research and their manufacturing part of their business is limited because they could only have certain employees, and sometimes in some cases they had to close entirely. So that portion of their business is going to be a partial shutdown. So therefore, even though they could fully operate on one aspect of their business, the other aspect they could not do. So they would be considered a partial shutdown and qualify, even if their revenue has gone, it has not had an impact. So this is kind of what I was just bringing up. What if a business is ordered to shut down, but continue operating with employees working remotely, or by changing the business's delivery model? So it depends on if the business can continue to operate in a comparable manner. If it can, then the business does not qualify for the ERC. Examples: an accounting firm is ordered to close its storefront, but everyone can work from home with no disruption in operations. That's funny because my kids were pretty disruptful and I had to work from home, which I still do. This business does not qualify for the ERC based on the shutdown orders only. They could still qualify under the gross receipts test, however. Another example is a retailer closes its stores due to customers due to government shutdown, but customers can still place orders online or by phone and pick things up curbside. Because this is more than a nominal change to doing business, the company qualifies for the ERC under the shutdown provision. Now, like I said, you don't have to, you might qualify under the shutdown provision, but your revenue technically could go up. Technically, you still qualify, but we don't have final guidance on that. So that's kind of a fine line people are going to walk. So will we take it for our clients? Yeah, probably. But they also might come out with something that says if your revenue has gone up, even though you had a shutdown, like you quote unquote pivoted your business and you started a different type of service or something, you have to kind of weigh out if it's worth taking the ERC because it might be disallowed. They can always just deny the credit and you just don't take it, which isn't a huge loss.
All right.
So I'm just going to do a quick first poll. I know I can find, where's my thing? Can someone else put a poll up, Amber or Jake? I can't find my who's he, what's its thing?
It's there.
There we go. Sorry. I'm going to launch this. Just want to get an idea of, do you guys plan on using the ERC and the PPP together? If you don't mind.
Just to piggyback off that, I think there's going to be a lot of court cases with business owners that are going to push.
There. A couple more. I'm going to give it 10 more seconds. All right, so I'm going to end the polling and I'll just share it really quick. So 75% of you said yes, 4% said no, and a lot of you don't know if you're eligible, which is, I kind of expected these responses. So we'll go into if you qualify for this. So, all right, back to this. Okay. Again, I have so many pop-ups for some reason. Sorry about that. Okay, so Continuing on the partial shutdown. So if a company qualifies under the partial shutdown test, you can claim the ERC for all wages paid during the time you are subject to a partial or full shutdown. So basically what it's saying is if you only qualify under the partial shutdown order and so you only qualify for the partial shutdown. You don't qualify under the gross receipts test. The only wages you can count were the wages paid during the time of the partial or full shutdown order. So it's not a full quarter like it is for the gross receipts test. It's just the dates paid. I'm assuming for most states, especially Massachusetts, New York, California, those kind of states, the partial shutdown order or full shutdown orders really didn't change that much, and everybody was pretty much still limited. However, just be clear on that. You don't get to claim the full quarter's worth of wages. You only get to claim the dates that the wages were paid during the shutdown orders, the governmental dates, and you can actually look these up on your state's website, and they have a full history of them to get the dates. So that's a pretty important thing to notate. So go to the gross receipts test, which is the other test, which a lot of people, this is the test we're doing first for clients. We're checking their gross receipts first, because if they qualify under the gross receipts, we don't really care about the government shutdown thing right away. So gross receipts in a calendar quarter in 2020 are down 50% or more compared with the same quarter in 2019. Again, it's really only second, third, and fourth quarters of 2020 that you compare it to. First quarter doesn't really count. Then once a business qualifies under the gross receipts test, it continues to qualify until the quarter in which gross receipts are at least 80% of what they were in the same quarter in 2019. I'm going to go over some examples of that because it's really confusing. It's much easier to see it visually. And then for any of you that have a new business or know someone that have a new business in 2020, they can claim the credit in 2021 using the 2021 rules, but there is no guidance on 2021 claims by businesses that start in 2020 because everything references comparing 2020 with 2019. So we're not exactly sure how that's going to work. That wasn't confusing too. So gross receipts. So to define gross receipts for profit, the IRS says to use the same method of accounting as prescribed in section 141, 440.48. I don't know why the little C is there. So basically what that means is cash or accrual-based accounting method, how you use on your tax return. So if you should know that, talk to your accountant, but that's what it means. Again, gross receipts is like your total sales, top line, gross revenue, whatever. Nonprofits, there's some ambiguity about this until the second stimulus bill, which states that nonprofits reference section 6033 means essentially that they're whatever the income, quote unquote, contributions, fundraising, they report in the 990, that's what they use for the gross receipts test. So an example, like I said, I go over for 2020 to determine if you're eligible for the ERC based on the gross receipts test is this. So the first quarter in 2020 compared to 19, it doesn't count anyways, but no, you don't qualify because it's the same. In second quarter, however, you had a huge reduction. You lost your gross receipts went down by 67%. You do qualify. Now the next quarter qualifies, even though you're only down 40%, you qualify because you still don't have less than less than a 20% loss. So that one down below it shows a 17% loss. So because you had the loss, the over 50% in the second quarter, that actually allows you to take the third quarter as well. It basically pre-qualifies you. And then because of that, you still haven't hit 80% of your revenue in the fourth quarter yet in the third quarter. So the fourth quarter, you do hit at least 80% of your revenue. However, and so you do qualify. However, let's say there was another quarter after that, it would not qualify because it's the quarter after you hit the 80% or more of your gross receipts in the prior comparable quarter. I understand this is very confusing. I was very confused when I first read it. I had to reread it, read examples over and over. But basically, if your gross receipts are 50% or more in the previous quarter, it qualifies you for the next quarter. And then you could qualify continually for all the way through the year, even through 2021. So it's a lot that goes into this. Another example is Same thing for first quarter, doesn't count. Second quarter, you do that loss of 67%. Third quarter, you only lost 17%. It does qualify, but because you hit the 80% or more in the third quarter, of your income compared to 2019, it does not qualify you for the fourth quarter for the ERC. I feel like there's a lot of questions. No questions yet. Good. So again, this is a very confusing subject, and the qualifications in the quarters, there's a lot of tests to run. And then what we would do is also see for maybe that fourth quarter, the shutdown, to see maybe they qualify under the shutdown provisions, the shutdown tests. So if a business meets the shutdown provisions, it qualifies for the ERC only for the time period it was shut down. Okay, so it's still kind of on a core basis, but it's really the dates that you're using that you were shut down. Okay, but it also might qualify under the gross receipts test, in which case it qualifies for that entire quarter and continues to qualify until the quarter in which the gross receipts are at least 80% of what they were in 2019. That goes back to the two examples before. So again, I personally were using the gross receipts test first because you can qualify for potentially a longer period. And then we're looking at the shutdown test. But you can use both. If you qualify under the gross receipts test, just use the gross receipts test. We don't need to even look at the shutdown. So for the employee count, this is when it kind of goes into the large employers versus the small employers. I'm not going into the above 100. There's a calculation to do it because most of you guys are well under 100. The ERC is available to any employer of any size, but an alternate calculation applies to employers that average more than 100 full-time employees in 2019. So for a small employer, you should have to have 100 or fewer full-time employees, and wages paid to any employee count. More than 100 full-time employees, only wages paid to employees who are not providing services, like basically not working. So only wages paid to employees not working, but whom the employer still continues to pay. So really, like I said, for people that are probably on this webinar, this applies to you for under 100 employees, basically all your employees count. This limitation has changed. It did go up to 500 for 2021, but again, we don't really care about that for the smaller businesses. Now, if you are concerned that you are 100 or more, there is a calculation to determine employee count based on, and their determination is 30 hours per week defines a full-time employee, and there are certain calculations, and we actually use an average using 2019 information. If you do qualify on 100 employees or more, you can easily look that up. So for the 100 or fewer employees, all wages count to all employees, including wages to both full-time and part-time employees, vacation pay and PTO and pay raises. There is one caveat to this, which I'll go over in a minute, but it's all wages to all employees. So like I said, PTO, all that stuff. Health insurance costs paid while the business qualifies for the credit can also count as wages for ERC purposes. Even health insurance paid for laid off employees. So if you laid your staff off, but you continue to pay their insurance for them, that does count too for the period that you qualify for the ERC. So this is employer paid premiums, pre-tax employee paid premiums, and I'll go into why they specify that because it's kind of silly what they did. But and then health reimbursement arrangements, HRAs, and medical flexible spending accounts. What does not count are any amounts paid to health savings accounts, so HSAs or MSAs. Those do not count, but health insurance premiums, regular health insurance premiums and HRAs, MSAs count. So over 100 employees have restrictions on wages and health insurance. So shareholder wages. This has been actually debated among the accounting community quite a bit. It's not entirely clear if shareholder wages are included. But some places say no, some places say yes. We've done a lot of research. We've talked to a lot of other accountants. We're saying they do qualify based on some of the tax code that they've referenced. So basically, we're saying that shareholder wages do count towards this. And we are going to be doing that for our clients. And a shareholder or an S Corp, they have to have, it's any percentage of shareholder wages. If a shareholder in the business, the ownership in the business. So to continue on, if you are an owner of a business, there are restrictions on related parties. So you cannot, the credit does not qualify for wages paid to children, your siblings, parents, grandparents, step-parents, nieces, nephews, aunts and uncles, and in-laws. But there are no limits on the owner or the owner's spouse. So if you have a child on your payroll, and a lot of people do, even if they've been paid historically on a regular basis, they're not supposed to count. I don't understand why, but they just don't count. So you can't just add. I mean, I get why they're doing it. They don't really want people to start adding people to payroll to get this credit, but still they are not included. But right now there's no owner, in our opinion, no limits on owner or the owner's spouse. So you can't go pay your mother-in-law. So there are wages not allowed. This is the one caveat I was talking about. So if you paid wages to a terminated employee, not the entire wages, just if you paid them like severance pay when they left. So that does not count because they no longer work for you. So it's that severance pay that you paid after they were terminated or let go or they left. But the wages before that, they do count even though they no longer with your company. I was confused with that at first, but it's just like the severance type pay. Then the other wages that the other limitation here is wages not subject to Social Security and Medicare tax. The wages that you're claiming must be subject to Social Security and Medicare tax in order to count. This is where people trying to do this on their own, another section, I guess, I don't know how they're going to do it because most people, even in the accounting world, don't understand pre-tax, post-tax deductions and deferrals. So if you have a statutory non-employee subject, is their wages don't count because their wages are only subject to income tax withholding, but not Social Security, Medicare. But statutory employees' wages do. I don't think many of you have that, but if you do, that's the rule on that. But then wages reduced by various deferrals, such as 401k. These types of deferrals reduce income tax, but not Social Security and Medicare tax. Therefore, they can be counted as wages. So I said before, it was kind of weird that the pre-tax deduction for employees, the pre-tax health insurance for employees was counted. This is why, because basically you're taking the gross wages and then you're deducting the pre-tax deferrals, which is going to be health insurance, but then you can take their pre-tax health insurance anyways. So it's kind of like you're subtracting it to adding it back in. But if you have something like pre-tax accident insurance, that has to be reduced from the gross wages because that's not health insurance. Or I believe even dependent care benefits. If you have something like that deducted from your paycheck, that's not counted. So it's not just a flat gross wages here. You have to actually do some calculations if you have any type of deductions coming out of your employee's pay. And there is no specific clear guidance on health insurance for S Corp shareholders, obviously, because that's just how they work. So we're not exactly clear on the health insurance for S Corp shareholders because it's not taxable to Social Security and Medicare, but it is to federal and state, but it's still health insurance. So we're not exactly clear on what to do with that. Well, there's a question. So a business was shut down by state mandate in 2020 and took PPP, hung on for a while, paid wages for a few months and closed completely. PPP was forgiven. Can this closed business now claim ERC retroactively even if they're closed? If so, how would they do it? I believe they actually can claim because they were still in business and it is a tax credit. You have two different questions in here. They've already done the forgive and forget. So how do you do this? You have to apply, you have to amend the 941s, which we'll talk about in a few minutes, but I believe they would qualify because they're still eligible for a tax credit because they still have to file their 2020 tax return. But how to do it, you do have a couple questions in there, but I'll probably answer some of those questions in a minute. I'm sorry, I'm just reading. Okay. Okay, 2020 ERC and claiming the credit. The credit must be claimed to the 941X. This will require amending the payroll tax forms 941 for each eligible quarter to make a retroactive claim. So this is where, and I took a webinar on this the other day, a 2-hour webinar, in addition to other ones, and the instructions on how to file these forms, the webinar pages was 30 pages long on how to do this. So if you plan on doing this by yourself, may the odds be ever in your favor. We will be studying extensively how to amend these payroll tax forms. There's several pages now, and it's going to be kind of a pain. The Form 7200 is only to be used for advances of the credit. This option is not available anymore in 2021 claims. So if you think you're going to be eligible or know you're going to be eligible for this credit in 2021, you can actually file an advance of the credit on Form 7200. Just a little insight here, the IRS, so all these forms are filed on paper, okay? Right now, the IRS hasn't processed 2019 returns. They have several million pieces of mail sitting on their desks right now, not being opened and have to go through. Me and my accounting friends are very curious as to see how these returns will actually be processed properly and checks issued. However, it's the only option available, but just to be aware that I don't think this is going to be a fast process, and maybe getting the advances of the credit and or filing the 941X for the 2020 is still a good idea, but I don't know how fast this money is going to be coming to anybody, because they haven't even finished processing 2019 tax returns or answering notices or anything like that, letters. Full of good news today. Next poll really quick. Do you think you'll qualify for it in the ERC in 2021? And we're going to go into the 2021 ERC in a minute. And I was very surprised when we were doing our client stuff, how many more clients qualify for the 2020 ERC as well as the 2021. A lot of people, I think, are going to qualify for the 2021 ERC, which is why this is so important to look at. All right, almost done. I'm going to give it 6 more seconds.
Awesome. Erin, at some point, and it could be at the end.
And also, this is actually why it's so incredibly important to have your books up to date. Because if you don't have them up to date, you'll have no idea if you qualify. So right now we've been actually reviewing even January profit and loss for our clients just to kind of track it. All right. So 40% say yes, 25% say no, and then 35%.
Erin, can you hear us?
I'm actually interested to see if this changes after I'm done with this section. Might be surprised. 1 second. So qualifying for the ERC. So the shutdown test is still the same as 2020. So you can still qualify under the shutdown test, same rules, all that stuff. Or you can qualify under the revenue reduction test, the gross receipts test, but it's now a 20% reduction rather than a 50% reduction. So as you can see, that is that's significantly different. And I think it's much easier for a company to have a 20% reduction in the first and second quarter of 2021 than it is a 50% reduction. And I think a lot more businesses are going to qualify than they realize, unfortunately, but that's how it's going to go. So the ERC in 2021 is now extended through June 30th of 2021. They may extend it for the rest of the year, who knows? The credit is up to 70% of wages paid up to $10,000 per employee each quarter. Sorry. Okay. Sorry, 1 second. I'm doing an audio check really quick. It's on. Hold on 1 second, guys. We're just doing a technical thing right now. Amber and Jake, you guys are muted, just to let you know. Well, Amber's not anymore.
Can you hear me?
I don't know why I can't hear you.
Okay.
You can't hear me either, right? Okay.
Okay, I'm gonna keep
Sorry,
going.
guys.
Sorry. I can't hear either one of you. So instead of the $5,000 limitation for the entire year, as it is in 2020 per employee, it's actually up to $7,000 per quarter per employee for the first and second quarter of 2021. So as you can see, that's a significant difference for 2021 compared with 2020, especially when the revenue decreases change from 50% to 20%. So as you can, this is why this credit is so important for people to look at. You could get, so I threw out an example the other day that, so if you have 5 employees that qualify for the ERC in 2020, you can get a credit up to $25,000 for 2020 for those 5 employees. For those same 5 employees in 2021, if you qualify both quarters and they both hit the 10,000, they all hit the $10,000 maximum in each quarter, you could qualify for a $70,000 credit for 2021. Obviously, that's enormous and definitely worth kind of looking into this. So the other change here is that it's also now a quarter to quarter test in 2021. So the confusing thing I talked about, how the previous quarter qualifies the next quarter, that doesn't necessarily follow in 2021. So, but there's again a caveat because it depends on fourth quarter 2020. But I don't really want to get into the weeds too much here. But according to this, the quarter has to qualify on its own. So first quarter 2021 has to compare with first quarter 2019. If that's gone down, yes. Second quarter 2021 compared to second quarter 2019, that qualifies it, except there's a caveat you can elect, but I'll go into that in a second for 2019. So you can apply for the 2021 ERC through July 31st as of right now, 2021. So I don't even know when we actually intend on applying for the 2021 credits for our clients. We're just going to be doing the planning and strategizing for spending the funds for the PPP. So that to answer that question, Sean, it says, can you apply for the 2021 ERC after 6/30 so we can determine the use of PPP first to ensure we do not double dip? So that's my answer there. So yes, I think we're going to wait and just amend the returns just to really figure out how we're going to spend the second round of PPP funds. So again, the employee count increases from 100 to 500 employees. More of the credit can be advanced. So you can file that 7,200 if you know you'll qualify for it. And none of this is retroactive. So these rules started in January 1st of 2021. They do not go back to 2020. So an example to determine ERC. So you had a loss of 25% compared to 2019, first quarter 2020 compared to first quarter 2019, you qualify because you're 25%. Second quarter, you do not qualify because it does not have a reduction in revenue, and it no longer qualifies under that, like the previous quarter qualifies you. So just the first quarter qualifies. Another example, so what I was talking about, let's say you test out your first quarter 2021 compared with your first quarter 2019, and it doesn't work. Like you don't hit the 20% test. All right, but you can then go back and test fourth quarter 2020 compared with fourth quarter 2019. If that's 20% or more loss, you can elect to use that quarter to make you qualify for the first quarter of 2021. Not confusing, right? Then the second quarter, it will qualify because you have a 25% or more loss. However, again, we're not sure if you elect, like let's say you elect to use the fourth quarter rather than the first quarter, we're not sure if they're going to make you do the same practice and elect the prior quarter to compare with the second quarter. So there is a chance the second quarter may not qualify based if they have to use the prior quarter, which would be the first quarter. And then Sean, I'm sorry, it says, what about the ERC 2020 ERC deadline for the 9/41 timeframe? Yes, Sean, it's the 7/31. You have to file it by 7/31. So an example for 2020 for qualified wages. So employees, let's just assume they all make the same amount of money every quarter. A makes 15,000, B makes 7,000, and C makes 3,000 a quarter. All right, so employee A in the second quarter, because we're just assuming you qualify all 3 quarters here, they make $10,000. Their credit is worth $5,000. They've maxed it out for the year. Okay, see that? So they don't qualify because they've maxed it out for the year. Next employee, they made 7,000. So they get 50%, they get 3,500. Okay. And then they make 3,000. So they get $1,500. They carry over. So the next employee, he gets only 3,000 of his is used up because is available because he used the first 7,000 here. And then the fourth quarter, he doesn't get any because he's used up all of his wages for 2020. All right. Because it's not a quarter by quarter thing. It's an annual thing. And employee C, each one of their quarters qualifies because they did not max out the $10,000 in wages throughout the 3 quarters. So then if you look at 2021, it's different because it's a quarter by quarter basis. So same wages, they're going to qualify for their full wage amount at 70% now. Okay. So employee A, their credit's worth $7,000 and then so on. So the full credit is $14,000 per quarter. So let's say all these employees made at least $10,000 per quarter in each of those quarters, they would qualify for a $21,000 credit. Right? I just said right? Yeah. Yeah. So per quarter, it's kind of a lot. So the taxation of employee retention credits, this is kind of, it's not confusing, but this is where we are trying to figure out what to do with this. So if you get a credit for this or applying, let's say we're applying for the 941 X's now for 2020, we're assuming you're going to be allowed to take these credits. We cannot deduct those wages, those specific wages, the amount of the credit you get on your 2020 tax return. However, how do we handle that right now? Right? Because 2020 tax returns are due right now, March 15th. But we don't know what your credit's going to be because we haven't planned. We have to do your forgiveness, we do all this stuff. So basically, and it directly affects your personal taxes. So basically, most taxpayers, they should probably go on extension if they think they're going to get the ERC credit. It just makes the most sense. Otherwise, you're amending all of this stuff. And if you also amend 941s, you have to amend other returns too. So it's not as easy as just, let's just amend the 941s. It directly affects the corporate tax return, your personal tax return. So this is not like a simple, just let's get the credit and move on with our lives. And the taxpayer does not have taxable income for the credit itself. However, they will have an increased amount of their taxable income. You have to get into taxes here with pass-through entities and all that stuff, but you cannot deduct the tax credit on the tax return. Bottom line, and how we're filing 2020 taxes is going to be kind of a mess. One second. I'm just reading some notes. So this is where, like, if you have a team that you're working with, you really want to make sure that your certain services, if you have payroll, you have a payroll person, let's say you have an internal bookkeeper and a tax preparer, they're not in silos here. They're not doing their own things and not speaking. Your team, so like for our clients, we pretty much do everything in-house for all of our clients. Your team has to talk to each other and they have to coordinate. You can't have your payroll company doing one thing and your tax, your tax person doing another thing, your bookkeeper doing another thing. You have to have everything coordinated. And this is probably for 2020 and 2021 and who knows for how long. So, and I strongly, as I do with a lot of stuff, suggest that you don't handle this yourself. But if you want to, that's your decision, obviously. But again, it's not a simple thing here, but it's worth a lot of money, as you can tell. So now we're talking about the ERC and the PPP together. So the December stimulus bill changed the 2020 rules regarding the ERC and PPP. Employers are now eligible to claim the ERC even if they received the PPP. I'd just like to reiterate this because some people still don't understand. They got the PPP. Yes, they can still use the ERC, but businesses cannot claim ERC on the wages it has already or plans to claim for the PPP forgiveness. This is where the planning comes in. Also, the other wages I have left out here, but also need to take into consideration. None of these wages can be double dipped with the FFCRA credit either, which is Families First Retention Credit, the coronavirus, the Families First, the sick leave credit that you also could have gotten. So that those wages can't be used either. So those wages are one thing, the ERC wages are another thing, and the wages you're using for the PPP forgiveness is another thing. So if you're doing retroactive credit, which is what the 941Xs are to get the 2020, it's going to be really tricky if you've already applied for forgiveness. So our first school of thought was when we were getting these PPP loans and doing these PPP forgiveness in 2020, we were like, just spend it all on payroll as soon as the 24-week thing with 24-week covered period was passed. But that's actually not going to do you any favors now. Now we want to basically spend just 60% on payroll and the 40% on non-payroll costs if we're cutting it close with these wages, which we're probably going to be. So it's just, it's not just cut and dry with the forgiveness either, as you can see. We have to go back. We did all this planning for all of our clients. Now we have to go back and do other things. So it's a very, very involved process, but again, obviously it can be well worth it. So again, you should work, if you do qualify for the ERC and you receive the PPP, you should work with your accountant to maximize both the credit and the forgiveness as much as possible. I don't recommend trying to quote unquote save money and do it on your own. No one ever really saves money by doing it on their own. It's like if I get my hair done through a box, probably is not going to be the best, for being honest. But for the 2021 PPP, we also have to figure out how we're going to spend the funds. That's why I was mentioning before, we're going to plan whatever we can for the funds that we're spending for the second draw PPP, but we're probably not going to apply for the ERC credits until after the quarters are over, because I don't even know how we're going to just coordinate all that together. It's just not even possible. And it's just better, I think, to do a look back and figure it out that way. It's also not able, you can't predict the future on what's going to happen either, for the most part, with people's revenue and things like that. So some steps here. Forgiveness hasn't been applied for in a 2020 loan, or if we're dealing with the second draw PPP loan in 2021 and the business qualifies for the ERC, again, we need to plan for how we're going to allocate wages. There is no clear guidance as of yet. And so we need to look at this to help the best way that we can to help strategically for our clients to spend the funds. And then you cannot use the same wages paid for PPP loan forgiveness if you use them for the ERC. Now, here's another catch. You're supposed to apply wages to the ERC first. So if you qualify for the ERC, you're supposed to actually use those wages before you use it for the forgiveness. I don't know who makes these rules up, but you can quote unquote elect to apply the PPP loan forgiveness first, the wages for that first. Where do you elect it? I'm not sure. I don't know if you just send up smoke signals and you just elect it that way, but that's what you elect. So my opinion is you figure out the PPP loan funds, you figure out if you qualify. Actually, I think it's in the next, I think I actually talked about this. Actually, let's do the poll really quick on how to do it. Hold on a second. Jennifer, I'm actually going to address your question. Her question was, I used 24-week period for PPP forgiveness, but only need 12 weeks to max out forgiveness. Do you think I still use 12 weeks of wages as they were not technically used for forgiveness? Yeah, Jennifer, I'm actually going to use that. I'll use you as an example. Oh, I'm thirsty. I actually need that back. All right. So a lot of you, I'm actually surprised, a lot of you applied for forgiveness already for the PPP loan. They say you can amend. I'm not sure how your forgiveness application. I'm not sure how that works, but this is why we've been super slow to do forgiveness with clients, because we wanted to be sure that we were making the right steps for this. But let's just keep going. Okay. So I'm going to talk about Jennifer's things. I'm going to give an example in a minute, but the first thing you want to do is see if you qualify for the ERC in 2020. Then you want to go back and calculate. You want to determine if you have enough wages and other PPP qualified expenses to obtain 100% forgiveness and get the credit Okay, so you have to go back and look at the pre-tax, gross wages, Social Security, Medicare, all that stuff, all that fun stuff, and figure it out. If you do, then you're going to go ahead and file your amended payroll tax returns to get the credit. Then you'll get a refund when the IRS processes it. And then if you've already applied for forgiveness, you're supposed to be able to amend your PPP loan forgiveness as necessary. You contact your bank, and then you'll modify your PPP loan forgiveness to exclude the wages that you want to use for the ERC. So Jennifer asked a question. A lot of our clients did this. Basically, we just said spend the PPP funds, and it's like called overspending in a way, the PPP funds for 2020, and use the full 24 weeks. But in reality, a lot of you probably spent the funds between 10 and 16 weeks, let's say, maybe 14 weeks. What we want to do now is, yes, we want to go back and say, so according to right now, we could actually say, let's say your covered period started July 1st. And you have 24 weeks. You could say, I know I spend my funds in 14 weeks. You could actually wait 10 weeks, use the first 10 weeks for the ERC and the last 14 weeks for the PPP. But again, you don't have to use all of the wages that you paid in the 14 weeks. Let's say, not like it just, you have, let's say you hired new employees, and those actually really don't need to go towards your PPP because you hit your FTE count, you hit your wage reduction count, and you hit the wage amount, and you're at 60%. You have non-payroll costs of 40% that you can cover, but you can get additional credit if you don't add certain employees or certain wages to PPP forgiveness, and you can use them for ERC. Yes, right now you can do that. No one says you can't. So there's all sorts of ways you can do this. It's just going about it strategically. I think the simplest way to go about it is the best way, and that's going to change for everybody. It's going to be a little different, but it's something you have to think about and plan out, and kind of really go back and analyze what you have. Probably rethink your process. Instead of overspending on the PPP funds, now you want to do exactly 60% of payroll costs. So for 2021, the next steps are going to be track your revenue compared to 2019 to see if you're 20% decline, delay. And so a lot of our clients, I've tried to communicate as much as possible. We're doing the second drop PPP loan with them. I've tried to communicate as much as possible. As you can imagine, absolutely slammed. We're not rushing these second drop PPP loans. The money is not going to run out. It's not going to run out. I mean, I'm not a genie. I probably shouldn't say that with absolute certainty, but it's probably not going to run out. 99% certainty. Okay. But I want to really maximize the benefits for our clients here. If they're going to qualify for that ERC in quarter1, I kind of want to wait till they get the second drop PPP and maximize that amount of credit for them. I'm not just going to rush and get the second drop PPP, but obviously this is if it's financially possible or feasible for our clients. If it isn't, then I have gotten some loans for people already. They're getting the funds, and they are going to get a portion of the ERC. They won't get like the full $7,000 per employee, but they'll get something, which is better than nothing. Then you want to plan and forecast out how you'll pay for wages and other non-payroll costs to maximize forgiveness in the ERC credit. And then you're going to go ahead and file for the credit quarterly payroll tax returns and contact your payroll provider to see how he's handling it. To my knowledge, most payroll providers have their heads in the sand about this. We use Run Wholesale ADP for our payroll platform. I guarantee you we will be handling all this manually and filing all manual amended 941 returns and not be going through ADP at all for this. I cannot imagine relying on any type of ADP filing or QuickBooks or Gusto or anything like that. And in order to file these manually, you really have to know how to handle a 941 tax return and do the tie outs the way that they're supposed to. Again, like I said in my webinar last week that I took, it was 30 pages of how to do it. So there's no open question. Let me keep going. So I tried to keep this as quick as possible, so we'd end an hour. So I know it's a lot of information to digest. Again, this is going to be available. We're going to send it out to all y'all after the webinar is over. And we'll make the slides available, the live recording. And we are posting stuff constantly via email and on social media. So we're here to help. Right now, we are pretty much specializing in just helping our clients with this ERC and second drop PPP. We are just extremely limited with our capacity right now. It's not only the craziest tax season ever, but we've had tax season since November 2019, if we're being honest. It's just never ending. We have this on top of it. And then they're also talking about, and they just passed additional legislation on the second drop PPP like 3 days ago. So it's honestly just not possible for us to help outside parties that are not our clients unless you become a full client with us. If you do sign up for our accounting services, then yes, we will help you. It's just how we have to do it. And we will have our pricing and all that for the ERC available in the next week. I am working on that. It's also very complex to try to figure out how to price it. But for our next webinar, we are hosting another webinar next Thursday. Actually, it's going to be, we're switching gears here and we've sort of ignored this topic, the Massachusetts paid family medical leave. This was passed from Massachusetts back in 2018, it went into effect 2019, but now 2021 is when employees can start collecting on this. We actually have one of our own that's on maternity leave and she's taking advantage of this. I think she's actually joining the webinar to give her personal experience, but it's been kind of a cluster, as you probably can imagine, dealing with the state and any type of benefits that you have to get from them. But so this will benefit the employers and employees. And it's actually really important because there's a lot of people, especially with this COVID stuff that's going on, that are maybe qualify for paid leave. So you should have received an email to register. It's on social media and all that. That's what that is. And so if you'd like to register for that, let us know. If you didn't get the email, let us know. And I know that Harry wants to talk about the IRS activities and backlogs. I cannot get him speaking. I don't know what's going on with anything here, but maybe I can try. 1 second. My father, Harry, the OG, would actually like to take, he said 2 minutes and 30 seconds to discuss the IRS backlog, just so people have a quick understanding of what's going on. So let me see if I can get him on. He's got two things here that Dad, can you hear me? Can you talk?
I can hear you. Can you hear me?
I can't hear anything.
Judy hears me.
We can hear you just fine. Harry, go ahead.
All right, so I'll take my 2 minutes, 30 seconds. There's two things really. The first thing is people in our business, in the tax business, with the issues with the PPP loans and all these ERC credits and everything like that. As you notice, we've had to split up some of the duties we do here, that not one person can do all this stuff. There's too much stuff to keep up with. But I try to keep up with the income tax side of it. And any of you are Massachusetts taxpayers that live in Massachusetts paying mass taxes of mass businesses may or may not be aware that the rules regarding the PPP loans and the loan forgiveness and income tax issues related to that, Commonwealth of Mass does not go along with the IRS rules. Of course, they've got their own way of doing things as usual, but they've been heavily pressed by the AICPA, that's American Institute of Certified Public Accountants, and the Mass Society of CPAs and people like me and groups of us to do something. And right now there's a bill pending called SD.172 in the Senate waiting to be voted on that would essentially conform the Commonwealth of Mass rules with the IRS rules for this PPP loan forgiveness. That may not mean much to you if you don't do tax returns, but people that do tax returns, it means a lot. It also will save our clients money if they do that, because if Mass doesn't conform to the same rules as the IRS, it's going to cost you guys more money for us to do the tax returns, because the work is a lot more intricate. And it's nothing but trouble. So that's on the table. Here, March 15th is the deadline for most business returns, S-Corp returns in particular. So here we are on February 25th or whatever day it is, and they still haven't passed that rule, but they're on it. The other thing is the AICPA, American Institute of Certified Public Accountants, along with all the other state societies, the other 50 state societies, has been pushing the IRS and U.S. Treasury to get their crap together. And the IRS says not. U.S. Treasury is, in my view, really out of control at this point. that internally they're a mess because they shut down for so long and didn't do any work. Aaron mentioned unopened pieces of mail. Well, the AFCPA called the U.S. Treasury and the IRS to announce any tax filing and payment deadlines by March 1st. By March 1st of this year, okay? Monday. That's, I think, next Monday. And what they're trying to get them to do is they want the IRS to admit that they cannot keep up with all this work. They haven't kept up with it. And there's no way they're going to be able to process tax returns by April 15th like they are supposed to. So they're trying to make them admit that and extend the due date out to June 15th. That would be for personal returns. We don't know what they would do with corporate returns. The March 15th deadlines, whether they would extend that deadline too. It only makes sense that they should because of the mess that they're in. And they also, one other thing, we talked about this in an office meeting the other day. Taxpayers who reach, the IRS has been sending out notices, and they're illegitimate notices. There's actually a House Ways and Means Committee Chairman Richie Neal calling on them to stop sending them out. IRS, the erroneous notices that they sent out, he cites the IRS backlog of roughly 7 million unprocessed 2019 tax returns. That's 2 years ago, 7 million of them. So, and as far as the amount of mail that's sitting there, Aaron mentioned several, 700,000 pieces of mail that are unopened. It's probably more than that. They're hiding the numbers because they don't know what the numbers are. And they're so out of control over there. They have no way of, I don't know how they're going to handle this stuff, or if they're ever going to handle it, or if they'll ever catch up. Just be aware that this is a moving target and that we could be telling you the tax returns are due April 15th, and at the last minute we find out that they're not due on April 15th, and we have to change up. We have no control over this stuff, and neither do you. So we just try to stay on top of it as best we can. It's a moving target. It changes every day, but be aware if you're getting notices from the IRS, chances are they're erroneous notices, but make sure you send them to us, because even if they're erroneous, it doesn't stop the IRS from pursuing them. And I could give you some horror stories about that, but it'd take too long. That was exactly 2.5 minutes. I'm all done.
All right, thank you.
Hello.
And just to give a quick example, we have a client that had a 2019, I think it was amended, or 18 amended return or something, and the state the IRS never processed it. The state needed the IRS to process it to do whatever they needed to do, and push come to shove, turns out the client's plumber's license has been revoked or suspended because the IRS has not done their job, even though the client did absolutely nothing wrong. I think they're actually due a refund. So this is just how bad it's getting. And also, I do want to say, if any of you are wondering if you get your return filed, there's a couple things going on. They're pending that they're up to $10,000 of unemployment benefits received may not be taxable for 2020. So that's another thing that we have. We're trying to send out something to our clients to if you just quickly respond, say yes or no, you've received unemployment benefits, because obviously we don't want to file your return right now if you potentially could have $10,000 that not be taxable. And then if you have filed and you are due a refund, they do have a tracking tool on their website as well as the state. Please just be kind to us and understand we have no control over your refund and when they're processing it, obviously based on what my father just said. So just be aware that refunds might take longer. And if you received unemployment, and they might even add other things, who knows, we're probably not filing your return anytime soon, but we need to know this, because we don't want to go back and amend your return later on, which we do unfortunately have to charge you for, because we've already paid for, processed it, did it for you. Then we have to go back and amend for you to get, more of a refund. That's how it goes. So there's just a lot going on. In addition to this ERC, PPP, all this stuff. So if you do have any questions, reach out to us. If you are interested in becoming a client, We do, service businesses year round. We take a very proactive approach. Our clients' books are updated on a monthly basis. We do everything we can. Clearly, we educate a lot. I do recommend, if you're an employer, just popping in for that PFML webinar next week. It is something you do need to be aware of for your employees. And if you are an employee yourself, and also business owners are eligible for the PFML. But we'll probably have another webinar on this in the somewhat near future. But again, we hope you have a great day, and thank you so much for attending. Oh, I probably should have announced. Yeah, there's one more thing to announce. But on Monday, Biden announced that he's only going to limit PPP loans, second drop PPP loans. Thank you, Debbie, for bringing that up, to employees, companies of 20 employees or less, starting yesterday. Today's Thursday, right? Starting Wednesday for 14 days. So if you have more than 20 employees, you have not applied for the second drop PPP loan before Wednesday, then you have to wait 14 days. Thank you, Debbie, for bringing that up. And there's also other calculations for if you're self-employed, if you are a sole proprietor, which I cannot find anything on how to actually calculate. You're supposed to calculate new things for a second drop PPP if you're a sole proprietor, and I have no idea where that information is. I have not been able to find it. So again, things are literally changing daily as per usual. Welcome to the world of COVID. Now I'm really done. So thank you very much. We appreciate everything. Have a nice afternoon.